So let's briefly begin with the mandate of the Banking and Financial Services Committee at the Kenya National Chamber of Commerce and Industry, where you chair. What's its overall mandate?
The Kenya National Chamber of Commerce is established to serve its members and act as an intermediary to connect members to various suppliers of value, lenders, and other related, even government offices. So they have divided, they have structured in such a way that there are specific committees that address a specific mandate. Like there are those that address export markets, those that address government lobbying, those that address manufacturing activities. So the Banking and Finance Committee is specifically to liaise between members seeking for credit or other support facilities from banks and try to seek for accommodative offering from the banks. So sort of like you're looking at getting a bulk price because of the chamber. You're looking at creating a specialized facility because of what the chamber members are asking for. So the Banking and Finance Committee then tries to get the members to connect to lenders who can be able to structure such facilities for the businesses.
Mm-hmm. Well, as the chairperson of the committee, what are some of the milestones that you'd say you have achieved under your tenure?
I think when we came into office, we were quite excited about the possibilities and the things that we were going to work out. But then what happened? COVID came in, and there was subdued activity involving financial transactions. But basically, what we had sat down and structured was first addressing the MSME access to credit from banks, which is a major area of concern, and involvement by the chamber. We were also looking at export-oriented businesses. Can banks be able to structure products like letters of credit and other related financial transactions or instruments that address export-oriented businesses, and also for purposes of trying to look at availability of long-term financing, particularly to the MSME sector, because long-term funds are difficult to come by in this market for that particular sector of the economy. Mm-hmm. The structure of corporate loans and the structure of SME loans is a little bit different, in the sense that if an SME is looking for long-term finance, it's probably for purchase of assets. And what the banks then will do is to provide asset financing, which is then tied to the life of the asset. So the asset itself then becomes the security for that particular facility. Now, therefore, then the servicing of the loan is tied specifically to the use of that particular asset. And so you'd find, because it's properly structured and it's actually being used in the business, if it's generating revenue, that revenue is directly used to service the loan. So most of them go for asset finance, and sometimes what banks do is that they are quick to repossess the particular asset that the business was given. This could be a motor vehicle or a machine that is used in the production process. And so because of the fear of repossession by the lender, the SMEs, you find that struggle to ensure that they repay the loan. The other thing is that without the machine, then they cannot continue with the business. So it's given priority. Unlike a large corporate which has a large pool of assets and is involved in multiple transactions, and therefore one side of the business may affect another side if one side is not performing well, and you find that a corporate has defaulted.
Mm-hmm. Now, will this help debunk the notion and improve access for credit to MSMEs? Or what are some of the things that we need to do to improve access to credit to some of these organizations? Because as you've said, sometimes the business depends on them diligently paying back their credit services.
I think from where I sit and having some experience in banking and credit per se, is to say that the challenge for SME access to finance has been the lack of accurate and reliable data. Because the SME environment is such that management of business data is not taken seriously. Where there is data, and the data can be used to evaluate the risk of the SME, I think that movement towards that direction will ensure that most banks develop the confidence to see that, yes, they can assess the risk of the SME, and therefore they can be able to determine how much to lend and what price to give to the SMEs. And because of that lack of reliable data, there has been a tendency to want to demand for collateral when looking at SME loan applications, and many of them don't have that collateral, so then they are not able to access the finance that they require.
What do you think is the biggest problem that faces MSMEs that is poorly addressed or least addressed and continues to be an impeding block and how can it be addressed?
Two problems specifically. One is the access to finance. And when I say access to finance, I'm looking at a broader picture. So what sort of financing do SMEs get from lenders? SMEs will get loans. They'll get overdrafts. They'll get asset finance. But what we find is that the structure of those loans does not usually meet the type of businesses that they do. So you would find, for example, an SME is not suitable for overdraft facilities. Sometimes banks would give overdraft facilities. An SME may be looking for long-term finance. Banks are restricted in terms of what period they can give long-term finance. It used to be 3 years, now they can extend up to 5 years, and I can see the period is being stretched to go into 7 years. But even as the period is being stretched, the terms on which they get this long-term finance sometimes does not suit their cash flows. So you find that it becomes strenuous. We need to see a situation whereby an SME can access finance for between 10 to 15 years, particularly if it is engaging in heavy manufacturing or looking at construction work that requires machinery that lasts for long. So usually the substitute has been that, can supplier credit be available? But even if you talk about supplier credit, suppliers also want their money quickly. So a supplier also needs to know that if they have given supplier credit, they can access their money by discounting bills or promissory notes that have been used in the transaction quickly with the bank, for the bank to give them quick money. So financing structure, the instruments that are required, and the structuring of the loans has always been a challenge when it comes to the SME market.
When it comes to MSMEs post-COVID, what future do you foresee for them in terms of credit access? Or even just staying afloat amid the pandemic and coming out of the pandemic on the other side still as viable businesses?
I think that it depends on what activity you were engaged in before the COVID pandemic broke up. Two things will happen. Some business models will have to change in the sense that if you needed to interact more with your customers, probably you may need to shift those interactions on a digital platform for you to continue selling to your customers and communicating to your customers. The other thing we think is that it is going to take time before customers come back to start buying what they were buying. During that time, SMEs may not have the money to sustain their operations, and therefore they will be constrained due to lack of cash flow. So if an SME is faced with that kind of situation, we probably will be looking at saying, are there any stimulus packages that can be provided to allow them to restart their business, be able to cover that period where they are trying to get their customers back, customers to get confidence to buy their product. So I think that is the challenge that I see, that delayed takeoff due to rebuilding customers' confidence.
During the first sitting of the year for the Monetary Policy Committee of the Central Bank of Kenya, they revealed that over 54% of loans in the country have been restructured. That's about 1.63 trillion of the 3 trillion in terms of loan books for banks. What does this kind of restructuring say about the health and the stability of the banking sector in the country?
In the short term, banks will experience increased defaults, because even if you restructured my loan, but my business is not back, I still will not repay that loan. I think that the banks cannot address these problems alone. The government needs to step in the sense that with a little stimulus package, governments will push businesses back into business, and as the cash flows begin to improve, then businesses will be able to start repaying loans. So in the short term, banks will experience a heightened non-performing loan portfolio. For businesses that close permanently, then that will obviously translate into a total loss for the banks.
Well, now when it comes to demand for credit, the CBK did a survey that indicated that 90% of respondents say access to credit has not changed since the repeal of the interest rate cap, while 10% say they've seen some changes in demand. What do you attribute this sort of disconnect to, and how do we increase the uptake of credit in the country? It's
simple, because we haven't gotten to a point where banks price risk in this market. Central Bank has been pushing for risk-based pricing, and risk-based pricing can only take place because credit reference bureaus are operating and active ratings of businesses are taking place in the market. Now, we know that credit reference bureaus have matured. They are able to provide the information that banks require to be able to calculate customer risk and price that risk. So I see it more as a journey, that until the lender is able to price risk, that's the only time the interest rate factor then will come into the equation. Because currently, they still tend to give blanket interest rate, so you don't feel that I have an advantage because I have a lower risk. I'm a low risk borrower. Low-risk borrowers are not being rewarded in the market. Of course, banks would benefit more if, for example, they were able to charge a little bit more for the marginal borrowers. Then the low interest rebates given to low-risk customers would be compensated for by charging marginal customers slightly higher interest rates. So then we would see a dynamism movement in terms of risk related to interest rates, as it were.
The Kenya National Bureau of Statistics indicated that the financial and insurance sector in 2019 grew by about 5.3% in the third quarter of 2019. And if you compare it to the third quarter of 2018, then there's a big difference, because in that year, the sector grew by about 8.1%. Besides the general dampening of the economy by the COVID-19 pandemic, what would you attribute this sort of contraction to?
I would attribute that contraction more to the impact of the COVID-19, because of the drastic impact it had on many businesses. Yes, the interest rate cap had been removed, but it has not been possible for banks to really determine the risk of a borrower during this COVID period. I think we looked at some of the risk algorithms, and you find that it is very difficult for you to predict what will happen in the next 6 months, in the next 12 months. Now, without that ability to predict, then it becomes extremely difficult for banks to put certainty on the lending. So banks have become extremely selective, go only to those customers that have very viable business and have a good track record in repaying their loans. Don't try anything new until you are certain that the situation has changed.
Now, well, the MSMEs have gotten some good news in the recent past, where the Kenya National Chamber of Commerce and Industry, in partnership with Equity Bank, had 200 billion up for grabs for MSMEs to be able to revive their businesses and help them stay afloat during the COVID-19 pandemic. How would you say is the uptake of this credit, and how far is it going in terms of impact?
I think that was a very good arrangement between KNCCIs and Equity. And what I saw is that Equity has a specific target to the MSME market. I think they are looking at being able to access about 3 million MSMEs in the market in the next 3 to 5 years. For KNCCI, I think this was a culmination of their mandate, that they can be able to connect their members to lending institutions. What we have seen is that the way the whole program was packaged, that the SMEs were to go through a training program before they qualify to access the funds, because the funds are 100% unsecured. And I know that some SMEs have already undergone the training program. I believe that we'll be able to know how many have actually been able to access the credit. But I think there was a slow process because of startup issues, training, also being able to see that you register as a member of the chamber before you can be able to access that stimulus package.
Now, when it comes to credit, longevity is always a very, very critical factor. Now, when you look at the country, the capital markets have been touted as the go-to place when you're seeking long-term financing. However, people and businesses are not seeking finances there. They're going to banks and also trying to do a consolidation of banks in order to have access to these funds. Why aren't we seeing people going for funding from the capital markets, either in terms of bonds or IPOs?
I have always argued that within our financial sector, there has been a structural challenge. Because we have a financial sector that is dominated by the banking industry. And the sort of what you call a crowding out effect. Because of the strong banking industry, the banks are able to provide both short-term and long-term funds available to corporates and other entities. Previously, the challenge with the Capital Markets Authority was the process, that it was taking too long to get the capital markets to process and authorize an issue, say, even of corporate bonds. Remember, there was a time when we had commercial paper, which was becoming very popular in the market. And commercial paper is a direct competitor of overdraft facilities for working capital. So what the banks did is that they were able to provide that money in a much shorter time with much better benefits than what anybody could get on the capital market. So the ability of the capital market to respond to the needs of business have been such that the banks respond much faster than the capital market. Banks have also been allowed to extend long-term lending using short-term customer deposits. For example, banks which give mortgages. You can give a mortgage of 15, 20 years, but you have not raised this money from long-term finances like the capital markets. So basically what you're doing is that you're working out probabilities to say that you will always be in business, and that short-term funds, as they come in, they will continue to fund your long-term lending in the market, which I think also is a problem. And because of that anomaly, entities have always gone to the banks to get whatever funding they require, whether short-term or long-term, because the banks also, even if the amounts are large, the banks are able to syndicate, come together and raise that money very quickly for the corporate.
Finally, what sort of policy interventions are needed in the country to increase uptake of affordable credit?
The use of ratings by lenders should become a mandatory thing. Customers should also be able to know that ratings provide a measure of their risk. And if customers can use their ratings to negotiate for better terms of credit from lenders, I think that will be a good move. As far as supply and demand is concerned, we see that the demand for credit is high and the supply for credit funds are available, except the pricing structure in the market is what has never been gotten right at any one time since the history of banking in this country.
That's everything. Thank you.
Thank you.
Thank you very much.